Okay, this is a model, this is a video, excuse me, about just completing a corporate model. Now, you know, I think some of the big issues with corporate models are just really understanding the implications of earning returns, whether in a certain industry returns can be sustained, and kind of understanding what the implications of a different market to book, EV to EBITDA ratio, and so forth are. Now, uh, uh, here, and of course in the corporate model, not of course. I keep on saying of course, but in a corporate model, we want to really, in just from a technical point, distinguish between history and the forecast. So I'm gonna start this video by making a little conditional formatting thing. And now if you're conditional formatting, if you're cool in Excel, you go to a new rule, and then what you can do is, I think, kind of the idea, I've just learned this by trial and error, is you go to the historic period, you press F4 a couple of times, that says, okay, well, and that's what I mean, I've learned by trial and error, go to the left like that. And then we can make this the history, so we can really distinguish between the history and the forecast. Now, if you made this history 2012, it would, change, okay? And the whole idea is making it really flexible so we can add new history to our analysis really easily and blah, blah, blah. You know what I'm going to do is I'm going to switch this so that's using the shift alternate right arrow. And then we have all these assumptions that were discussed in another video. Right now we're going to we made some operating analysis of revenue. And you know what? I should probably call this operating analysis EBITDA analysis, which is, of course, the most important thing you're going to do in the whole thing. And then once you have the EBITDA analysis, we'll compute working capital, CapEx, and then we need some financing analysis. Now, in the financing analysis, let's put the cash balance here, and instead of that, let's put the net cash balance, debt cash slash debt balance. Now, and we're going to put an opening balance and add the cash flow and put a closing balance. Now that means, well, as soon as we do that, and then we're going to split this up between the cash balance, and we can put an interest income rate, and then we can compute the interest income. And this is where we have the classic circular reference in a corporate model, interest income. Now, then we can put our debt balance. Now, you could, when you do this, you could, and then put interest expense rate, and then you put interest expense. Now, you could, we're going to put a minimum cash balance to do all fancy stuff. We're going to use the opening balance, so we have this. And what we'll do is, first, let's not put any interest income in the future, okay? So we're going to split this closing balance into cash and debt balance. We're going to do something different in the historic, compared to the forecast. This is a very mechanical video. I wish I could say something more interesting, but I guess at the end of the day, you really want to see if your return on equity, return on investment really kind of makes sense, okay? Now, if let's start with this. The closing balance of the cash and the debt is if, we're going to always use this if statement. If it's the historic switch, then we'll put the cash, and now I think when we put the assumptions in, remember you go up to the assumptions. Maybe I should have closed the rest of this. We'll put the cash minus the debt. Is that okay? I think that's what we did, cash minus debt. Alright, and then as usual, we didn't have, in this case, the this, and then we're going to have to get that from the, whoops. Now, here's the problem. If it's a history, we'll do that. I didn't say what if it's not the history. If it's not the history, we'll take the opening balance plus the cash balance, okay? Now we can Shift Control R, so you've got kind of the whole thing set up, okay? And now we need let's get the profit and loss statement. Let's put our revenues in. That's the cash expenses. Now this should be really straightforward. EBITDA less the depreciation. Each of these items should be straight. EBIT. If you've seen some of the other videos, you know this already. Less the interest income, interest expense, plus the interest income, and let's also add the other income. And the other income is an item that we put in our assumptions when we worked through the whole balance sheet, and here's the other assets, and then hopefully I put total other income, and we had the historic level, and we made some kind of assumption with respect to that. And if we would have put our 3 here, we would have just put 0 other income in here, okay? And then after we do this, we can get our EBT, and then we could put some net operating loss in here, but right now I'm just going to put less taxes, and then get earnings, total earnings, and then we can also put less minority interest in this one. And then we can finally put earnings to common shareholders. And what we might do is, just to make this a little more transparent, the only thing we're really going to need is the tax rate and the minority interest percent. And now, when we get this all finished, here's what we hope. We hope we can get our historic earnings, and then we can put the difference and put a test. And the final thing is, we should really put the shares, and then we can put the earnings per share, because that's really the thing we're after. That's what we want to do. And then here's why. Let's finish this, and let's put the EBITDA. Let's put less the taxes paid. Now I didn't put any deferred taxes in, which I should. Less the working capital changes. How about cash from operations? And then less the capital expenditures, and then we can put the cash before financing. And then once we put the financing in, let's put less the interest expense, which we already have, and then add the interest income. No, it would be really easy to forget this is what I always forget. I tend to forget. We can add the other income, net. And then once we get that, we can get the net cash flow. And I forgot the dividend. Let's put some dividend payout ratio. Why don't we put on common shareholders, dividends for common, and we can also put dividends for a minority. And the only really thing we need in this case is kind of like the tax rate. We need some kind of dividend payout ratio. And in this case, I was thinking about this as I'm doing this, I think it'll be best to simply put that dividend payout ratio as the same for the minority and the majority. And then once we get this, we can put the balance sheets in and get some financial ratios. So that's what we're going to do in this relatively simple model. Now, again, I'm repeating myself, but if you, at the end of the day, have a ROE that's moderate and suddenly goes up, or a return on invested capital that's reasonable and suddenly starts shooting up, you really need to ask yourself questions whether you have a reasonable model. That's the big deal, and then we can see what happens to some ratios for the debt as well, and we'll graph those out, and that will be the subject of our next video. Okay, and we'll put common equity here and put an opening balance, add the income less the dividends. This is all to common, so then I put a closing balance. Now we can do exactly the same thing for the minority interest. Okay, and then finally we'll put our, once we have this, then we'll put our balance sheet together and see if it works. Okay, I don't know. I hope that's not too loud when I put my silly fingers on this. And the reason we went down all the way to this is now we can get our cash flow. In fact, we can get it from the first year. It doesn't really matter because the closing balance in the history has nothing to do with it. The closing balance is forced in the history, but then as soon as we get to the forecast, then we have a number. Ah, shit. Control R. Okay, so we still don't have it yet, but then we're going to do that. Now, if we do this really simply on this one, we put if it's the historic switch. Again, the historic switch is such a beautiful thing because the historic switch, this was cash, I hope. If it's the historic switch, we'll use this. Otherwise, we'll use maximum of the bottom or zero. Now, I would strongly suggest, instead of trying to get really fancy with all your financing, I would strongly suggest when you make your first cut at the model, keep the financing as simple as possible. Now, let's just leave that out. So then we'll do the same thing for the debt balance. If it's the history, then we'll go up to our financing assumptions here. we'll take the historic debt. They had very little debt. Otherwise, we'll take maximum of the this closing balance, or 0. But when we take that, we'll put a minus on it. So we'll only take it when it's minus. We'll switch any minus to a plus and then take it. Okay. So what happened there is, since it was positive, this just went to 0. Okay. And then we can, just go up and put our tax rate in, just like we have for everything else. And you might want to graph all the income statement items. But when you go through this, look for where you put all of the stuff. So we put depreciation and taxes in this section, and then the minority interest percentage, that would be one of the where was that? The minority interest percent was down here. Okay, and then now we can go, instead of the assumptions, go to the working analysis, or the whatever you want to call this, the EBITDA analysis. Okay, and then we have the difference. They don't have a very big margin compared to all their revenues, but that doesn't mean anything at all, really, because so this was EBITDA, and then we put our depreciation, and again we have the depreciation defined, and you should go to the section on the depreciation expense, and then you take the difference, of course, and that's your EBITDA. And then you can take your interest expense, which we haven't computed yet, but don't worry about that. And then we can take our interest income, which again we haven't computed yet. And finally, we can get the other income, which we have computed, because we put a little section down here for other total other income. Okay, and here's what we hope is then, and then of course we have this minus. We just go over into the side and see what it said to do. This minus this plus this plus this. Okay, and our taxes are this tax times the tax rate up here. That's why we put the tax rate. That's the only real calculation we make other than the next one. So you know what I'm going to do right now? I think that the best thing to do is to start putting some underlines here. When I was in 1982 or something, when I was working for an accountant, it was hell. I got in trouble for not putting the correct lines in all the time. Okay, and then this is the difference, and we'll just put that in. Okay, and finally the minority interest. We put another calculation in here. That's the minority interest percentage. Okay, and then we put the income to the common shareholders as this one. Okay, and I'd want to check this and make sure that it's the same. Now, so far we don't have that, and then we can get this number of shares too. I think I've got to put that in later, and then we'll get that and get the difference. But before we do this, let's just get the dividend payout ratio. Again, you have to be good at looking for things, but the dividend payout ratio was right here. That was in the assumptions page. We can take our EBITDA from this, and then we go to the, we're going to pretend the taxes are the taxes really paid, and then the working capital changes. Well, we made that special calculation of working capital change just here. Okay, and then we got our cash flow from operations, which is just this minus that minus that. And of course I guess that's a good idea to press Shift Control left arrow. And then we made in another section, we put our CapEx. Okay, and then we take another difference, and that's our Shift Control left arrow. That's our difference. Now on the interest expense, we can put that. Interest income, we can go to the next one. And finally, the other income we can put. That's an easy one to forget. And the dividends, well, we have the dividend payout ratio, and we can put that and multiply that by the earnings to common shareholders. Okay. And now the interest to minority shareholders, we could do the same thing. Multiply this by the minority interest. Okay. I'm pressing Shift Control 1 just to get that off. And then we finally, whoops, you see, I should have done it the other way. Okay, the net cash flow then is the last subtotal minus this one, plus this one, plus that one, minus this one, minus this one. Okay. Shift Control left arrow, and then we have this. And now we really are ready to go with all the financing. Okay, let's just select this whole thing, and here's what it should happen. Hopefully, we can start testing the balance sheet right now. Don't have to put any interest income, any interest expense. We really have all of the stuff we need. Now, to make the balance sheet balance, the first thing you do is we're going to put this from the balance sheet. Now, we'll do the same thing. If it's the history, let's go up and take the total. This was, I put it in here somewhere. Common equity. Is that right? Okay. If it's the history, we take this. Otherwise, we take, as usual, we go to 395, and we put a plus. Oops. Oh, no. Oh, shit. If it's the historic switch, then we go up, and we take the actual financing, and we go find our assumptions on that. Notice I'm not very good at finding these assumptions. Otherwise, we take the opening balance, okay, plus the income minus the dividends. Minus the dividends. Okay. And we can press Shift Control R. We can put it, the opening balance equals the prior year closing balance, Shift Control 1, Shift Control R. And now we can only compute this now because we do have the earnings and we do have the dividends. Okay, Shift Control R. Now what happens is, why do I have some positive numbers here? I guess we did the EBITDA, we did all that. Dividends, why was the dividends equal to 0? Was the earnings 0? No. Oh, we did, oh, I did, oh my god. This was just a mistake. So when we have the financing analysis, we go up to the all of our assumptions. And when we go down to our assumptions with respect to financing, which should be kind of the last one, when we put the dividend payout ratio, how many other falses did we have? Actually, that was the only false we had. You know, I think we didn't do this thing right. Okay, we just shift down, Control D, and we had a 62 or 72. Let's say it's 70% in the future. Okay, and that means we can put an if statement around this, of course. Not of course. If I say of course, again, I should get some kind of electric shock to stop me saying that. And then we always press this one. That's the other video that explains how to do that. Okay, and now we have some numbers in the future. Okay, and that's our we have the closing balance and then the opening balance. Now we could do exactly the same thing with the this. Now we go on the income this time. Instead of getting the very last level of income, it's not kind of surprising, you get the minority interest. And on this one, instead of getting the total dividends, you get the minority dividends. And then you put an if statement, and if it's the true, you go up to the balance sheet, which I have closed. So I'm gonna do something really stupid. I'm gonna put it here. Otherwise, we take the opening balance plus the income minus the dividends, just exactly how we did the common equity. Okay, and I think we better open up the balance sheet. Remember how we could do that? So this was the first one was actually the balance sheet. Okay, and what were we looking for? We were looking for minority interest, which, you know, we have the total equity. I said, you know, how would you know that? So this, when we take the equity and the minority interest, it should be this. Although I think I actually put it somewhere. Whoops. Okay, and where are we? Dividend payout ratio, minority interest. Actually, I think in the historic period, I think we, instead of having to go to the balance sheet, I think we put that down in the assumptions page. So we're still in the working analysis, and if we go up here, and we can find the minority interest. Oops. Uh-oh. Oh, shit. Ah, shoot. What did I just do? Oh, man. I hope I didn't. Oh, no. Why did this happen? If 03, then oh, fuck. If P3, oh, no. That was really bad. Okay, that wasn't a big deal. I just did the year wrong. I just accidentally copied the year across. Oh, it was a little bit of a scare. Okay. So, where were we? On the minority interest, we're gonna put this in. So we put, if it's that, K40. Oh, did I copy? I think I didn't copy this. Then we copy this, okay? And then once we have this, then we can put our assets in. And we can start with our cash assets. Well, Yeah, let's put it in a standard kind of an accounts receivable, inventories, other current assets, and then why don't we put net plant, and then we can put other assets, and then down here we can put total assets. And what we want to do is check that, Shift Control plus a bunch of times. We want to make sure, and then we can have historic assets. And then we can pay the difference. That's our kind of first test. And notice I'm switching things around, but here's the rule. I've probably told you this before, but we're going to review the rule. The rule is that when we do this, everything should be defined already, especially if we just did especially if we put the equity in just like we did, which you really have to do. So far I've gone to this, and then we'll put other current assets. Okay, and then finally we can put the net plant, not finally really, and that's in our depreciation and section, and of course, and then we have other assets which are in our assumption section. We have other assets down here. Okay, and then we can press alternate equal, and we can press Shift Control R, and then we're going to test whether this is the same, and it's going to be different because I'm sure I made a mistake. So we can go to our balance sheet. I hope we open that, and we look at our total assets, and oh my god, it looks like it's the same. So that's our first test kind of the balance sheet. We didn't do anything complicated. We've got one tiny little bit of a one difference here, which doesn't seem to be a very serious matter. Probably some kind of rounding error when I typed something in, because what we should really do is test whether now, here's the problem. We have the total liabilities, total is 264,004, but this wasn't exactly. We should maybe we should test this. Okay, so if we take the current assets plus the non-current assets, oh, that did work. Perhaps we made it. Well, I'm going to look for that one. I'm going to go nuts with it, probably. Seems to be. I can't see what I did wrong, obviously, but something. Okay, but it's pretty good. And then let's put the liability side. Okay, so we'll put the, and then let's put current. How about accounts payable? And then we have that. Whoops. And then we can put taxes payable. And then we can put, I think that's the only current assets we had. And then we can put the debt and the equity. How about minority interest? And then we'll put the and then we'll put the common equity. put the total, and we should up here put other liabilities, just like we put other assets. When I do that, I'm pressing Shift spacebar and Shift Control plus or Control minus. Okay, and let's see if we can get the kind of historic level defined. And then what I'll have to do is switch it off and find out what that one is. That little difference of one is driving me completely crazy. Okay. But we can start with the bottom. That's our equity. Our minority interest is just the one we just did right above that. And then the debt is, we computed that in the debt section. Just, where is the debt balance? Just right here. And then the other the other liabilities, that's a tricky one. That's going to be in the assumption section, so I'm going up to just check the assumption section. Other liabilities. Okay, and then we have the, let's put the taxes payable, and that's just, again, this time you go to the working capital section. Here's our profit and loss section, here's our planned balance, and what did I just say we were doing? I can't even remember what we're doing. Here's the accounts payable level, and then we're going to put the taxes payable. Whoops. This indeed was the taxes payable. Okay, and then we'll put the accounts payable last. Okay. And I'm getting very tired. I've had a couple of beers. See, I can't even see what we're doing. Okay. We said this was the taxes payable. And we put the accounts payable in this one. Can't even see anymore, and then we are finished. Okay, and I think we've kind of identified just about every asset or liability. We count it in, we can press alternate equal. Okay, and Shift Control 1, Shift Control R, and Shift Control R. Now it's clearly there's something wrong here, and I'm going to stop the video and see if we can reconcile why the assets are not equal to the liabilities even in our historic period.